Earlier this week, Beijing saw a record price paid for a single plot of land. The land was auctioned for the equivalent of over $400 million US, or around $6,300 per square meter. As China's economy approaches a critical juncture, more attention than ever is focused on its real estate sector. In many ways, Beijing's real estate policy is not specific to one sector, but reflects and shapes the economy as a whole. Real estate alone accounts for over 10% of China's GDP. When related industries like steel and concrete are counted, it amounts to around a fifth of GDP. In short, it's more than a sector, it's a microcosm for Beijing's fast and furious model of economic growth. With Beijing facing an overall economic slowdown, real estate policy shows us how Beijing itself perceives its country's economy. Against this backdrop, the auction in Beijing has received widespread notice. On the one hand, it's seen as an omen of what's to come in terms of real estate prices, something the Chinese public is increasingly sensitive to. This is especially so as property prices rose to as much as 20 times the average salary in many cities following the 2008-2009 stimulus package. On the other hand, the auction may also signal a shift in Beijing's real estate policy, which for the last year has clamped down on speculation in land sales. Given the sector's importance to China's growth, any move to loosen restrictions could provide a major boost to the country's suffering economy. But in the long run, these changes would be a setback for Beijing's efforts to move away from investment-led growth and towards greater domestic consumption. In reality, though, the bigger risk is short-term. By turning to real estate, Beijing may be able to reignite growth, but that growth will come at the price of making the economy less stable. In many ways, the real estate sector is the one part of China's economy that Beijing has the most trouble controlling. Notably, some of China's largest state-owned enterprises were featured prominently among the recent land sale's 46 bidders. This is new. For most of last year, state-owned enterprises were not allowed to publicly speculate on property. That's because many of these companies helped to inflate the bubble after 2009, taking advantage of easy credit to drive up the market and in turn their own profits. As a result, residential property prices soared in major cities. So did the risk of an economic crash triggered by a burst in the bubble. If this $400 million auction is any indication, these same companies may now be openly re-entering the market. A rebound in the real estate market, even if moderate, will help state-owned enterprises shore up rapidly declining profits. In fact, many of these companies relied heavily on property speculation to offset other losses throughout the last decade. It would also help local governments who rely on land sales for revenue. Finally, it would help private speculators who often have to put up property as collateral for new loans, usually to build more properties. All of this would help kickstart growth in the near term. But in the long run, it would hurt ordinary Chinese citizens, the vast majority of whom cannot afford to buy a home anywhere near a city. While speculators and developers can sustain the market to an extent, at a certain point the market will break unless the average Chinese are able to participate more broadly. This being said, Beijing may be forced to sacrifice the long-run good for a short-term boost in growth. Second quarter data shows the structural problems China is facing. Weakening external demand, especially from the Eurozone, continues to hurt China's export sector. Meanwhile, sharp drops in commodity imports in June do not bode well for industrial activity in the coming months. Overall import growth for the month was down to 6.3%, about half of what most economists expected. And all this happened despite Beijing's efforts to renew investment in large-scale infrastructure projects. Beijing knows it needs to stabilize housing prices. The rapid collapse of a property bubble could bring the whole economy crashing. This is especially concerning given how connected the sector is to China's financial markets and major state-owned companies. But the government faces a dilemma. It wants stability, but faced with another global economic downturn, it may have no choice but to fall back on real estate to kickstart growth at home.